Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of March 1st, 2026. And in this week's episode, we are going to go through some of the random market musings of myself. It's just me, Sprocket888, this week, and I'm going to touch on a little bit of where the indexes sit relative to historical levels and some of the caution that I'm putting out there right now in the market. And then I'm also going to touch on a little bit of AI sentiment. So recently, there has been a lot of market activity where software companies have really just gotten hammered on the premise that AI is going to wholly replace those software companies, make them obsolete, and the valuations are just getting crushed in that area. So I'll offer a little bit of my comments to that. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. In this week's content, before I jump into it, I want to kind of give a reference here that this is my 259th episode. And that is a lot of episodes. Actually, I've been releasing this every single week, uninterrupted for almost 5 years. So one episode short of 5 years. So there's going to be some changes upcoming to the format and things like that. I think I'm going to kind of scale back. We'll talk a little bit about that on next week's episode, which will be the 5-year weekly episode release in a row. That should make some interesting discussion on next week's episode, where I kind of celebrate the 5 years of releasing an episode every single week, and kind of reflecting back on that and kind of also projecting where I might go from this path forward. But jumping into the stuff around here, for most recently, the market musings that I have going on. It's really been kind of an interesting area in the market. If you've kind of paid attention to my Theta Gang feed, you might have noticed that, boy, you sure haven't put very many trades on this calendar year. And that's true, and it's for a number of reasons. The first one is a lot of my buying power is kind of currently tied up on different trades and stuff that I had towards the end of 2025. Not all of those things have kind of closed out. They've gotten breached, and I've ended up holding shares, kind of battling back from some of the hit that some of those things took. But one of the other reasons is I just really feel like we're kind of in a transitory phase of the market. Means we're not really full bull, and we're not really bearish yet. It's kind of like the market is trying to decide what's going on. And that really kind of brings us to the first market musing that I really have on this week's episode. And that's the market index levels. So the market indexes, this is going to be your NASDAQ, your S&P 500, your Dow Jones Industrial Average, the Russell, where they stand, how they've traveled over the past couple years, months, weeks. This is something I keep an eye on for kind of a longer term trend perspective. I don't really track it so much on the near term of what it means for tomorrow. But it is something that helps me gauge what's the overall sentiment in the market and how is that relative to where we have been historically. As you know, I'm kind of a reversion to the mean trader. I kind of look for overextended volatility, and there's a lot of things in the market that, well, you can kind of go up and to the right. You'll go through periods of stretched growth, stretched valuation, and then you'll kind of contract, consolidate, come back to earth, and then you'll kind of keep continuing higher. So it doesn't mean that you need to actually fall significantly, but you just can't go parabolic. And so I keep an eye on the indexes because those are the aggregate of the underlying stocks. And two of the big ones that I follow are the S&P. I would probably follow that second most. The Russell's what I follow the most. The reason I follow the Russell so much is not because I think it's as representative of the market. I think the S&P is a better representation of the market than the Russell, but the Russell has a lot more volatility, and sometimes I like to trade that volatility. So when the Russell starts picking up a lot of volatility, I might try to sell some options against it. Lately, as I've mentioned in a previous episode, I've actually traded raw futures to kind of try to scalp some of the daily moves. So I kind of want to jump over here to the charts. And I really want to just take a look at the S&P on the weekly candles. So each of these candles are weekly. So this is a really, really long-term chart. And you can see on the bottom there that we're going from basically 2022 up to 2026. So we're covering 4 years here with weekly candles. And it's really kind of interesting. You can see the volume or the height of these candles. So the volume are the bar charts down at the bottom. And you can really see around mid 2023, the volume of what's trading in the S&P really picked up. And around that same time, you'll see that the candle height of the S&P really picked up. And what that candle height is really kind of alluding to is volatility or movement up and down. So the way that those candles work, right, is the top of the candle and the bottom of the candle. Those are the range, the open and the close. And then your wicks are basically the min and the max within that week. And you can see a lot of movement. But what I really want to call out here is the height at which this has really kind of climbed. So we're talking significant distance up of, down here to up here. We're talking, a significant 320% move on the S&P index. And that's a very, very high move over those years. And we've had substantial returns in the S&P yearly. And if you really look kind of historically at the S&P, you just don't get a year after year after year of 20, 25, 30% growth, just boom, boom, boom. But we've really been on one heck of a bull run. And if you even just look at the price action and the charting, we're really kind of stalling out up here is what it appears to me around this 50 to 54,000 level. And this kind of brings me a little bit of caution. If you look at kind of historical events here, right, we got your this is in 24. We had a trace back and kind of a sideways consolidation. We had a run up. We had a trace back, some sideways consolidation, another run up. So, we could be having a little bit of trace back, a little sideways action while we consolidate. Maybe we'll drop it down a little bit further than where we are currently before we kind of continue on higher. I mean, indexes generally are always up and to the right over a long period of time, but you get these points of fatigue. And these points of fatigue really are when opportunity, in my opinion, opens up on the underlying things that make up this index, because that's where a lot of those underlying stocks are going to go through violent volatility, deep discounting, things like that. And so this is an area where I'm starting to get the feeling that we might not be parabolic on all of the underlyings anymore. And we could get some down to earth valuations, some consolidation. And really what that will drive is volatility will drive up. It will drive the prices of the underlying down. And that is just prime put selling environment where you got high volatility. You can get your put strikes well below the current price. If you end up hitting them and getting assigned, you're likely in an oversold situation. So you're going to get a nice boost back as the price kind of recovers. If the volatility is overstated, then you get to cash out without ever owning the shares, but keeping the premium. And so this is starting to look like an environment that I'm very interested in. And so that's why I'm keeping a lot of cash kind of on the sidelines. Not a lot, but that's why I'm kind of being very hesitant to jump in now, is because I want to see some of that pullback, some of that consolidation really come to fruition. Now, if we also go look over at the Russell, we also have a similar thing happening here where this is the Russell over basically back to 2020. This is the huge drop in 2020 around COVID. We went sideways, we came down, we went sideways, we came up. And if you just look at the gain that we've had, we really breached down into this level. I thought we were going to settle into this nice channel that we had previously, but we only briefly hung out in there, and then we just skyrocketed up to our current levels in valuation here in the Russell. and this is higher than the Russell has ever been. But you'll notice the Russell does a lot of this either sideways move or kind of a correction and then a sideways move. And so like right here, we peaked up, we got basically to the highs that we had back in 2020, late 2021, early 2022. And then we dropped all the way back down to kind of the lows there of 2022. And so presumably we might be coming back down to test this weekly 2000 level. Maybe at the minimum, we're coming down to test this 2450 level, which was the previous kind of all-time high that we double tapped. And so again, this is just kind of another signal to me that the indexes are starting to become a little bit fatigued. And this brings us to kind of the next market musing, and that's geopolitical events. And so there's a lot of headwinds that are out there in the market right now, or a lot of risks or uncertainties. And market really doesn't like risks. They don't really like uncertainties. That typically drives volatility. So over the weekend, the U.S. has launched attacks jointly with Israel on Iran. It's something that's been building. The market's kind of been pricing that in from an oil perspective and things like that over the past couple of weeks. The tensions have really been building, but that's a big, big unknown. That's a big uncertainty, and its impact to the market. We'll see how it goes this week in the market to understand how stocks and how indexes kind of react to that, how the price of commodities like oil react to that. But that's kind of a big deal. And if we look at that headwind, it's another reason that, look, the indexes are already looking a little bit toppy. They're already looking like they're kind of going into a consolidation phase, maybe a slight correction phase. And when we start sprinkling in more data points of risk and uncertainty, that kind of further bolsters kind of my opinion there on where the indexes sit. And that brings us to my last market musing point, which is really interesting to me because I'm kind of a technologist. I like a lot of technology. I like to see it advance. I like to see it evolve. I like to watch that progression. I like to be involved in that progression, mess around with the technology over time. And AI has always been fascinating the past months, even up to years, on how the market has interpreted that technology. And how the market is predicting that technology will impact things moving forward. So we've gone through all different kinds of market phases with AI, just super dreamy phases, super bearish phases, just all kinds of different ones. And the latest one is really this premise that AI is so good that it is going to completely dissolve the need for a lot of the software middleware companies. And what that's done is that has taken these software companies, software-heavy, software primary companies that focus on a lot of that middleware, a lot of the integration points, stuff like that, and just absolutely decimated their valuation. So some of these companies we're seeing daily moves down 10, 15, 25%, just absolutely rocking the valuation. Now, one could say that they were very kind of overvalued to begin with. Ironically, a lot of the valuation spiked up on the advancement of AI, saying, hey, this is really going to help make them more profitable. They're going to be able to lose headcount. With less headcount, they're going to have less expensive. Their margins are going to increase. And that's kind of progressed to the point of, well, maybe AI is going to get so good that we don't even need those companies and people can just do it on their own. And so that's really been kind of an interesting thing. And the reason I find it interesting is because I don't really believe that any technological advancement completely makes a industry or sector obsolete overnight. Certainly, it will change the way we do things, but change is always slow. And while change is progressing faster, more recently, there still is a change. And so you can think back to all the different technological advancements, and it would decimate some companies and make them obsolete? 100% they will. But it will not because of the technology, but because of how the company reacts to that technology. And really, I think that's true for the companies today. Is these companies, the technology companies that rely on technology, really will have to rethink the way that they do their operations, the way that they make their money, the way that they make their profits. Because AI probably truly will change the way we work. Will it replace some things? Probably, but most technology, well, it replaces, it usually opens up additional doors or additional avenues for work or impact there. And I think that's the uncertainty that we're in, which is why I kind of get excited when these companies get absolutely smashed down, because to me, that means a lot of these companies are kind of being put on sale. And that's where you can kind of come in and take a look at these companies and say, hey, which one of these things really might be able to adapt, change, and modify their business to succeed in the new environment? Because that's where you're going to get some killer deals. When the world thinks that everything is ending, they sell it all, burn it to the ground, and you can come in at a very good price and be able to pick up these shares. And so a lot of the software company is also starting to approach this time period where I believe selling puts, which is one of my favorite trades to do, a very viable trade. Now, I'm not quite ready to jump in whole tilt there because I really want to see how the overall sentiment of the market pans out. And the reason for that is if the market was in a sentiment of overall bullish tilt and really kind of marching higher, then I would probably be jumping into a lot of these software names right now. Because it likely means that recovery will come quicker. Now, if the market sentiment is a little bit more bearish, more sideways, you're going to end up kind of getting a risk-off trade. And risk-off means they take out of growth. A lot of funds and money will come out of growth, come out of speculation, and go into more staples and value and stuff like that. And that's going to further kind of degrade the valuation of these software companies. Because really, these companies are priced at a growth valuation. They are priced as a speculative asset. And so if there's an overall negative market sentiment or building negative market sentiment or even sideways market sentiment, I don't believe that the price rebound comes as fast and as hard for those speculative and software and growth-based companies. And so that's where I'm also kind of waiting out a little bit on the impact to see how the overall market sentiment goes. And if these indexes start to level off and start gaining, then to me, that's a signal that the sentiment is kind of not ready to do the correction, not ready to do the pullback quite yet. And that would be a signal to jump into those software names selling puts. Now, if the market overall sentiment and index starts to drop, correct, I'm going to wait for that thing to start to find a bottom or start to find a local minimum. And that's the point of which I'll start shopping around for those software growth or really any other names that get thwacked down in the correction, in the sell-off, in the market rotation, because that's where you're going to have high volatility, and that's where you're going to have lower prices, and you're going to get the best put selling options in that condition. So that brings us to the end of this week's episode. Again, one episode away from 5 years in a row of weekly episodes. This is just random musings that I've had on the market, just my raw thoughts on what I'm thinking about, what I'm seeing, what I'm reading, how I'm feeling about it. Not a lot of technical aspects to kind of take action on there, but it's really where I'm giving pause right now based on the overall index trends, the index price action, the market sentiment, and a lot of the headwinds that are out there in the market, from geopolitical events to AI interpretation to its impact to software businesses, growth companies, services business. All of that stuff is really in a lot of question. And to me, that's wonderful, because that's the type of thing that's going to drive up volatility and drive down prices. And that is the perfect environment for put selling, which is my most favorite trade to kind of do. So I'm really kind of holding out a little bit to see how the dust starts to settle before I start jumping into those put sellings. And it's really not a window that will close too super fast. Once that window starts to open, I expect it to be there for a good week or two before it really starts to correct. And even as it corrects, you can still keep jumping in successfully at picking and choosing shares because not everything hits a bottom at the same time. Not everything approaches the bottom at the same time. Not everything recovers on the same timeline. So I'm looking forward to seeing how some of that stuff pans out in the market and what kind of opportunities that's going to afford me. But until that starts to happen, I'm kind of pulling back on a lot of my trades, waiting for the dust to settle, working out some of my existing trades to free up more buying power and just kind of be ready with some powder on the sideline. So hopefully you found this interesting, and hopefully you're finding your own strategies out there in the market today. Is getting pretty crazy, which is kind of awesome if you like a lot of volatility and movement. Otherwise, I hope you're finding things to trade, profiting on them. So good luck out there, have fun, and remember, think outside the block.